Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. We're all data dependent, right? I'm not sure what the alternative is, but I know we got a bunch more data this week, including a game-changing CPI report, new forecasts from the Fed, and the latest temperature read of small business, courtesy of the NFIB. And let's not forget all the political drama in Europe. And through it all, markets got better. Stocks up, spreads tighter, the 10-year lower. It's what B of A's head of equity and quant strategy described as, quote, kind of awesome, unquote. We might describe it as, quote, kind of toppy, unquote. This week, our three things are: 1. Visibility. We compare today to a year ago. 2. Financial conditions. The Fed says they're tight. Are they? And 3. Tech impact. It's really about creative destruction. All right, let's dig a bit deeper. Visibility. Goldilocks. Awesomeness. Exceptionalism. Markets priced for, well, perfection. All this exuberance strikes us as a bit irrational, given that we have a global wave of political dislocation, 2 hot wars, and a path toward a slowing economy. So what gives? Well, in a word, visibility. Today, it's better than it's been in some time. We were talking with MarketWatch this week about volatility in markets, how the Treasury market has settled down, and how stock market vol is at the lowest level since before the pandemic. Investors are now confident, if not complacent. They're confident that the economy is proving to be exceptional and resilient. They're confident that inflation is coming down steadily. They're confident that the Fed will not derail the economy. They're confident that a higher cost of capital is manageable. They're confident that the financial system has the capacity and the willingness to continue to funnel capital to its most productive use. They're confident that corporate earnings growth is going to remain positive. And all of that, by the way, is a big improvement over where we were a year ago in terms of visibility. And with improved visibility comes improved conviction around, in this case, the soft landing narrative. All good, right? Well, because we're fixed income folks, we feel compelled to remind listeners of the following. 1. The effects of higher for longer in this go-around has a longer tail than what's been typical in the past. Ordinarily, effects are felt 18 months or so after the first hike. Well, we're now more than 2 years past that first hike, and we believe the effects are still playing out. That's because of the extraordinary era we're in as a result of $10 trillion of stimulus. Now, it's taking longer to slow that freight train down. Take Powell's word for it. This from his presser this week. We think rates are restrictive. Well, that means everyday rates remain at this level. The economy is slowing further. And 2, we've only had one soft landing in the past 50 years. That was in 1995. Turns out it's really hard for central bankers to thread this needle, finding the right level of rates that cools demand without pushing the economy into recession. And it's hard to be precise. You're trying to time 2 massive and powerfully moving forces, growth and inflation, colliding into one another. And I know there's a dual mandate, at least in the US, but let's be honest. Your goal, first and foremost, in the eyes of your all-important peers as a central banker, is to tame inflation back to a rigid target, come what may. It's easy to understand why the Fed overshoots in almost every case. Now, you have to admit, it is kind of awesome at the moment. But as always, it's really about where we're headed that matters. All right, on to our second thing, financial conditions. Now, we hear a lot about financial conditions, something the IMF defines as how easily money and credit flow through the economy via financial markets. The Fed has long talked about the tightness in financial conditions. Markets claim the opposite. So who's right? Well, we looked at a relatively new measure of this difficult-to-dimension condition, one published by the New York Fed. Its index, which points to whether financial conditions are a tailwind to GDP growth or a headwind, is fed by 7 variables. Fed funds, the 10-year Treasury yield, the 30-year fixed mortgage rate, BBB bond yields, the Dow Jones Total Stock Market Index, the Zillow House Price Index, and the Dollar Index. Makes sense. Those seven seem to capture money flowing through the economy. One element missing from our perspective is bank willingness to lend, easily measured in the Senior Loan Officer Survey. But let's not rain on the Fed's quants parade. So let's see where each of the Fed's factors is at the moment. Fed funds is high by the Fed's design, so that's a headwind. The 10-year is high compared to the post-GFC era, but we know zero interest rate policy is a thing of the past, so we really should think about this as maybe a touch above normal. Let's call it a wash. Call it neutral, neither a headwind nor a tailwind. The 30-year mortgage rate is clearly a headwind at the moment as buyer and seller expectations are in the process of resetting. BBB bond yields at 5.6%, we'd call that a tailwind. The stock market at all-time highs and historically high multiples, well, that's a tailwind. Home prices, ditto. And the dollar's strength has many puts and takes, so let's call it neutral with regard to financial conditions. So, back of the envelope, we come out with financial conditions overall being neutral, some good, some not so good, which is exactly where the quants at the New York Fed come out. Not surprisingly, we had financial conditions that were strong tailwinds to growth back in 2021, strong headwinds to growth in 2022 and 2023, and now we're back to neutral. Turns out, neither the markets nor the Fed is right on this issue, at least at the moment. Maybe we should factor in the money supply, which is coming back to trend after pandemic stimulus took it to bubble-like heights. Now, all of that cash is, no doubt, still bidding up risk assets, including credit. All right, on to our third thing, tech impact. And we've been blinded by the light, lulled into a sense of complacency by the power of technology companies that are transforming industries. It's driven broad-based equity multiples to elevated heights, but underneath the high flyers, away from the bright light, the story is not as compelling. We saw a fascinating interview this week with Jim Chanos, the now dialing back king of short selling. When asked about AI, he provided this interesting context. The internet changed the world, right? Few would disagree. But in the decade immediately post the birth of the internet age, call it 1998 to 2007, the U.S. economy grew 3% a year. In the immediate decade prior to the birth of the internet, 1988 to 1997, the U.S. economy grew, wait for it, 3% a year. So the internet did nothing to goose the economy's overall growth rate. It did, however, drive big winners and big losers among companies. We find that to be useful when sifting through what we see in risk markets today. Here's an interesting data point we tripped across this week, courtesy of Rosenberg Research. The equal-weighted S&P 500 index, by the way, that's our preferred measure of corporate health, as a percentage of the cap-weighted S&P 500 index, is at its worst level since March of 2009. That exuberance we see in the stock market clearly sits on a handful of names. The equal-weighted multiple is 16.8 times, a touch above its long-term average. The cap-weighted, well, that's at 21.1 times, well above its longer-term average of 15.9 times. What do earnings underpinning those multiples look like? Well, in 2024, the S&P 500 is expected to grow earnings by 9.5%, and interestingly, ex the Mag 7, that forecast growth rate is still 5.6% to the plus. Well, that's not all that bad. Now, where the real separation comes in is in smaller companies. Of the Russell 2000, 42% of its companies are unprofitable. The aforementioned NFIB monthly Small Business Optimism Index for May came with this commentary. For 29 consecutive months, small business owners have expressed historically low optimism, and their views about future business conditions are at the worst levels seen in 50 years. Well, not much ambiguity there. From a sector that generates 40% of GDP and employs half of the labor force. Now, we continue to point to the two economies, one driven by wealthier consumers and big business, and the other represented by lower income/asset households and small business. We are concerned that the latter is underaccounted for by investors. So there you have it. 3 things in credit. 1, visibility. It's pretty clear right now, and that supports lofty valuations. 2, financial conditions. It's a mixed bag, but generally constructive. 3. Tech impact. Identifying winners from the losers is critical. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.